Hello, and welcome to this edition of the Capital Stewards podcast. It's almost summertime, and you might be thinking about taking a road trip over the summer. The airlines have certainly expressed in their earnings calls that you aren't planning on flying anywhere. So I'm hoping that everybody's still planning on enjoying the summer with their families on the open road. Trump's trade policy of late has been sort of like a summer road trip. We started off at home in April. We ventured out to an unknown and uncertain land, and now we've returned home, at least mostly. So I wanted to share a few thoughts in this episode on the economy and markets since our last update happened right on the heels of Liberation Day, and we've now journeyed quite a ways in a short period of time. Our Q2 outlook was titled Tariffs Equal Recession, and that was true based on what we learned on Liberation Day. Tariffs that essentially cut off trade with China and significantly raised prices on imports across the globe would have resulted in a recession in the second half of this year. Since then, the highest tariffs, known as the reciprocal tariffs, have been rolled back in two phases. First, the week after Liberation Day, when the stock market jumped almost 10%, and then again this past weekend when Treasury Secretary met with Chinese representatives to negotiate a pause on the China tariffs specifically, albeit with lots of carve-outs, sort of side deals and adjustments kind of going on throughout the month. In numerical terms, the simplest way to cut through the noise and boil down all the tariff policy is just to think about tariffs as a percentage tax on total imports into the U.S. Prior to Trump's inauguration in January, the U.S. tariff rate was somewhere between 2 and 4%, so low single digits. During the peak of the U.S.-China escalation, the average tariff rate rose to about 29%, so somewhere just below 30%. And now with China's base tariff rate reduced, the effective tariff rate on the whole economy sits somewhere around 17%. Those figures come from the Yale Budget Lab if you want to go to their site and read more about the math. It includes some of the expected changes in consumer behavior to adjust the tariffs to other factors. So you can adjust those numbers by a few percentage points. The point is we started pretty low. We got up almost, 4 or 5 times, right? And now we've come back and tariffs are still high. We went from 4% to 29%. Now we're back to 17%. So we haven't gone all the way back into the single digits. We're still higher than we were, but certainly less than where we were a week or two ago. Our view going into the second quarter was that the economic growth was slowing and the unemployment market was weakening. But absent a shock, we could hang on to sort of very low growth in the U.S. The initial tariffs provided enough of a shock, in our view, to push the U.S. economy into a recession. Extremely high tariffs would have caused consumers to buy fewer things, reduce their spending on services to offset higher goods prices for the things they still had to buy because everything wasn't going to be substitutable with something that was made in the U.S. And higher tariffs would probably also cause some companies to lay off workers to protect their profits that got squeezed with higher tariffs. So that none of that was going to be particularly good for the economy that was kind of hanging on by a thread. So what's likely to happen now that tariff rates are lower? All those reactions that I just mentioned are still all going to occur, but I think the net impact will be small enough that we can probably likely skate by with low to no growth instead of having an unemployment-driven recession cycle in the back part of the year. The incidence of tariffs, or who pays the tariffs, is something that's going to come into the sort of discussion and the national conversation over the next few weeks, and that's different by industry, and it has a lot of impact on the economy. It's likely that some companies are going to raise prices to cover their increased costs, despite what you may hear. That's likely to cause the consumer price index to stay above the Fed's 2% target. We saw April consumer price index CPI data hit this morning. It was relatively benign at 2.3% overall. CPI excluding food and energy, or core CPI, was 2.8% though. The latter number is what we care about because that's what economic policy can influence, the Fed and the U.S. government. We don't have a lot of control over energy prices. Those are big global markets. Lots of things can happen around the world that influence those, but we can adjust interest rates and fiscal policy to support core inflation, and 2.8% is still pretty far above the Fed's 2% target. You might be thinking tariffs should increase prices, right? Maybe more than 2%, and that's right, but it's going to take a few months. It takes 2 to 3 weeks for a ship to cross the Pacific from China to the U.S. to L.A. So those goods that are subject to the tariffs that hit in early April are just now arriving in the U.S. Then they're going to sit in a warehouse. They're going to be shipped more on a truck to a local distribution center, and then they'll finally make it to retail in the next couple of months. So I wouldn't expect to see major tariff impact on prices until June or July. I think even May probably will be pretty minimal. Those price hikes, even at the 10 to 30% level, I think are going to keep inflation elevated for a couple of quarters and keep it from falling back to the Fed's near-term target. We had expected tariff rates to be so high that the resulting price hikes would essentially stop consumers from buying, which would create a recession and cause the Feds to lower rates before inflation really became a problem. Now I think it's more likely that the slower burn of price increases keeps inflation where it is now. There are some natural forces like housing and other parts of the economy that are trying to push inflation lower, but you're going to have this pull upward from price increases short term. So I think inflation is likely to sort of stay around where it is now, maybe tick slightly higher over the summer. And that means that interest rates have to stay higher over the summer for longer because the Fed's not going to cut rates until they see inflation being under control or they see the employment market have problems. And we'll talk about that more in a second. But that doesn't seem to be something that's going to happen in the near term since the tariff regime has been rolled back a little bit. Some companies are not going to be able to raise prices. We see evidence in the economy that the consumer, particularly the bottom 75% of folks, that's most people that are out there, they're tapped out. Wages are not growing. They're not keeping up with inflation of late. And those consumers, they've already got credit card balances that are back up from very low levels, back to sort of normalized levels. They simply can't increase their spending. They don't have the money to do it. So they're unlikely to just absorb a price increase if companies raise prices. So that means that some companies are going to look for efficiencies in their business models and lay off workers as a result to offset the tariffs. I think the impact there is just small enough in magnitude because, again, some price increases, some corporate spending adjustments and cost reduction initiatives because we only need to offset, something that's around 17%, not something that's around 30%. I think the impact there is just small enough to help us avoid a huge spike in unemployment and a recession. But again, I think, the unemployment market, the employment market's going to continue to weaken. We're going to see unemployment drift just ever so slightly higher. Not be in such a good place. And then finally, some of those tariffs, you hear this talked about a lot, the foreign countries are going to pay the tariffs, right? Some of the tariffs will be absorbed by foreign goods producers, but just like the split between US consumers and businesses, whether foreign suppliers lower their prices depends on how much power they have in their respective industry. Some may have strong margins and might be replaceable by other, by their US buyers. So if a US buyer can go to another factory or another producer, then they will be able to extract some concessions from their foreign partners. And so those foreign partners will absorb some of the tariff and they'll reduce prices. But in other cases, you may have a foreign supplier that's the only producer of a particular type of good. And in that case, they're going to hold the line on prices and they're going to force changes elsewhere. So whether incidence falls on companies and they lay people off or consumers, they pay slightly higher prices, or a foreign supplier and they reduce prices, the reality is the impact is a little bit felt by all three. I do think companies, though, solve for sort of 10 to 20% issues pretty regularly. And so I think they'll ultimately solve for tariffs as well after a short adjustment period. So are we out of the woods? Does that mean that everything's okay? Hey, companies are going to solve these problems. Now I think it's actually an even more difficult environment to navigate for investors as we go through the remainder of the year. Coming into the year, the economy was already slowing down. Then spending and investment activity picked up considerably to get ahead of potential tariffs in the first quarter. Now we expect to see some payback in the form of less capital spending, investment, and consumer spending in the next quarter because people went and bought cars and they went and bought stuff that they thought might be subject to tariffs. So the economy is still slowing down. Rates are still high and they're holding down economic growth. But tariffs are causing prices to rise in the short term. That's the classic definition of stagflation. So perhaps a mild case of stagflationitis for the remainder of 2025. So what does that mean for investors? First, I think how you navigated the last 6 weeks will leave you either well positioned or not as well positioned to go forward from here. And it's not irrecoverable if you're not well positioned, but I think if you navigate the last 6 weeks well, you'll be well positioned starting out. Over the last few weeks, ideally, you are realizing losses to use as tax write-offs, rebalancing portfolios, sticking with your long-term investment plans so you didn't get whipsawed by these big up days and the down days that we've had in the market. Year to date, the S&P 500 is kind of flat now. So, it'll certainly be up probably after today. You should have positive returns, right? So you shouldn't have negative portfolio returns. If you weren't doing some of these things, then I suggest sort of taking a look at how you're managing your investments and talk to your advisor. Going forward, I see this still kind of as an anemic environment for stocks. Valuations are expensive, right? So we're paying a lot to buy the future earnings of the companies. They want a lot of money to buy a share of their company. And the environment isn't great for them to increase earnings. So back to our thesis in January, everything needs to go right for expensive stocks to get even more expensive. And that certainly hasn't been the case so far this year. And there's going to be some more bumps in the road as we go through the impact of the tariffs that have been in place and those that were in place we get into the summer. So that means owning stocks. So this is not a, hey, you should sell all of your stocks. That's not the message. But it does mean you should be careful not to allow your stock exposure to get outsized in your portfolio. This is not the same investing environment that we were in from 2009 to 2022, where you can buy the S&P 500 and let it ride. The growth of large cap companies, especially big tech, was supported by interest rates that were essentially zero, which created outsized advantages for large companies, network effects, scale, things like that. They could borrow or raise capital, scale their businesses, and compete really effectively. Now, with interest rates back to sort of more normal levels, that means that the cost of capital is higher across the board for everybody. With the 10-year yield kind of in that 4% range, that means investment returns are going to come from a broader group of assets. So far this year, boring intermediate bonds have outperformed the S&P 500. So have gold and international stocks. I talked about this last fall, but with rates higher, it makes sense to look at a wider range of fixed income assets like corporate debt, high yield bonds, so corporate bonds that maybe are where the companies are a little bit less credit worthy than the investment grade market, private credit, et cetera. Those are, again, not taking huge amounts of risk. If you take a lot of risk, you can actually get double-digit returns in some of those cases, but you can take a little bit more credit risk and you can produce high single-digit returns without taking on equity market volatility. So since a hard recession is off the table now, I think looking at some of these higher yield debt, emerging market bonds, places like that, high yield, are attractive assets that folks should think about. Additionally, gold is probably the best true hedge against future inflation, stagflation, and an unexpected downturn in the economy. Remember that if the S&P 500 moves up to the average sort of Wall Street target from here, which is around 6,000, we're talking about 3% returns. So again, I think considering to own a balanced portfolio with lots of different assets, gold, different kinds of fixed income assets, et cetera, you can produce those high single digit returns month after month after month, along with your stock exposure. So that doesn't mean sell all of your stocks again, but I think staying balanced, staying true to your asset allocation framework is really, really important as we kind of navigate things going forward. It's really easy to sell at the bottom, right? When things were bad in April, and then chase returns at the top of the market after a run like we've experienced over the last few weeks. The key to investing is usually doing exactly the opposite. We want to stay disciplined throughout all the different kinds of environments. So I hope this was helpful. It's kind of an update mid-cycle to what we see happening in markets and the economy. Thanks for listening and watching this episode of the Capital Stewards Podcast, and I will see you next time.